may be seated. Without taking much of your time, let me take this opportunity to welcome the Minister of Finance, Economic Development and Investment Promotion, Professor Mtuli. You are welcome. Let me also welcome the Permanent Secretary in the Ministry, Mr. George Govamatanga. Welcome, sir. Without taking much of your time, let me call upon the CZI Vice President, Clara Mlambo, to give us welcome and opening remarks.
Good morning, ladies and gentlemen. May I begin by recognizing and welcoming, and I know that the protocols have already been said, but I'll still continue, Finance, Economic Development and Investment Promotion Honorable Minister, Professor Mtuli, Deputy Minister and Absentia, Deputy Minister of Finance, Economic Development and Investment Promotion, Honorable Kudakwashe Mnangagwa, Permanent Secretary for Finance, Economic Development and Investment Promotion, Mr. George Govamatanga, our ZIMRA Commissioner General, Ms. Regina Chinamasa, other senior government officials here present, CZI President, Mr. Mucham Kanganwi, BAZ President, Dr. Sibongile Moyo, Chamber of Mines President, Mr. John Msekiwa, Zimpaper Chief Executive Officer, Mr. William Chikoto, CZI National Council members, fellow BMOs, professional bodies, business leaders, and all stakeholders here present. I think by going through this list of protocols, fellow speakers can write off the protocols, off the quote of these protocols. Thank you very much, everybody, for joining us. We would like to welcome you to this very special edition of the post-budget breakfast meeting, which is a gathering of policymakers, business leaders, entrepreneurs, labor, civil society, and analysts to go through what prospects the 2026 budget presents to all of us. We've actually been very fortunate. We had a pre-breakfast session with the Minister, the Permanent Secretary, the Commissioner General, and we've already discussed some of the key issues. This is a special edition because it is right off the back of the launch of the National Development Strategy 2, which is one of our key milestones towards the upper middle income society visited by 2030. As CZI, we value different views and perspectives that feed into policy opinion and into policy and business decisions. We believe in evidence-driven approaches in our engagement with the policy environment and are grateful to our members who are our collective capacity for analysis and information, and to members of our various key committees drawn from the membership who lend their expertise to the organization, of which many are here today. I'd like to acknowledge the members of our macroeconomic committee, our tax committee, and the CZI Industrial and Economic Research for the comprehensive work that has gone into the analysis that is informing the dialogue today. And Honorable Minister, we have submitted a paper to yourselves which will give the detail of the output of these committees. Today's dialogue was preceded by pre-budget consultations, submissions and representations, so various teams did go to the Minister's offices, post-budget representations from members, analysis and pre-meetings that we had with some of the BMOs, and a roundtable by economists with the collaboration. The purpose of just mentioning this is just to indicate the inclusiveness of the submissions that were actually made. I welcome you all to the dialogue today and would like to take this opportunity to thank you all for being part of this occasion. We will mention just very few people specifically, the Honorable Minister and the Ministry of Finance for trusting us to co-host this post-budget dialogue together with Zimpapers and yourselves. are participating BMOs and professional organizations. I won't list them, but thank you very much for the inputs. Our sponsors, without our sponsors, it will be very difficult for us as CZIs and papers to pull off this type of level of crowd. So thank you to the sponsors. And please, can you continue sponsoring us? It's very, very important. And the reason why we're just thanking everyone at the beginning, we know that everybody's got very busy mornings and some might leave during the course of this morning, but ideally, if you could stay, it's very important because it will be a very, very interactive discussion. And I know just from the pre-breakfast discussion that we had in the briefing room, the minister has a lot to share and to respond to the various elements of the budget and to provide insights which we can then take forward as we go into our businesses later on today and for the rest of the year going forward. So thank you very much.
Thank you. Without taking much of your time, let me call upon Mr. James Wadi to do his presentation.
Right. All protocol observed. And good morning, Minister. My presentation is difficult to present to the Minister who has produced the budget. It's like you are trying to go over the thing that he told you. I hope I will try to bring the perspective that I wanted to bring from the budget that was presented by the Minister. We were celebrating, we were celebrating the size of how Zimbabwe has grown over the period of time. And when I was looking at the GDP size for Zimbabwe, when I looked at the African economy as a whole, at about $53 billion, I realized that Zimbabwe is 16th ranked in Africa. And that is a milestone, given where we've come from. And when I was looking at a lot of these numbers, thank you. So when I was looking a lot at these numbers, when I looked at the trend analysis, at some point I realized that maybe 4 or 5 years ago, we were almost the same size as Zambia. So having grown almost twice as much, I think speaks of volume in terms of resilience and potential of the economy if things are to be well aligned. And I also want to take cognizance of the areas that government has looked at in terms of easing of business and a lot more other issues. However, there are certain aspects that I wish to bring to the fore in terms of what this size means in reflection of other parameters like the economic size, the banking sector systems, when I compare ourselves with the regional countries. Why I like to compare with regional countries, because it gives us a kind of measurement to say how are we faring against other competitors. Be that as it may, I have put a slide that speaks to, first of all, maybe manufacturing sector. Now, manufacturing is one of the now largest contributor to GDP. When I looked at the trend analysis, at around 15% of GDP, it's quite significant. However, when one starts to look at the contribution towards exports, we see a little bit of weaknesses there. At around $500 million, which is 6% of total exports, I think there is a room to say how best do we position ourselves so that we can support manufacturing. In my view, manufacturing should be doing at least $1 million as a start. So we need to redouble in terms of our export performance when I look at that. So there are a lot of other issues which have been spoken about around manufacturing. Having said that, I went to government expenditure pattern and revenue. So I've just touched various aspects of the economy. So I went to revenue performance over a period of time. I know there have been periods also when we've been affected by the El Nino weather pattern, but also when you look at my bottom line of the graph, it shows the transitions that we have gone through from a currency perspective. US dollar era, RTGS, ZWL, ZIG, and so on and so on. So we have transitioned over time in terms of the currency regimes. But I think what is also clear for me is that when I look at the revenue, from 2025, over 10 years, we have doubled the revenue. But also expenditures seem to be outpacing revenue growth. So in as much as we have grown from a revenue perspective, our expenditures remain key. I think they remain problematic. So I think this is a common theme that I saw over a period of time. Revenue growth, very strong, but also expenditures seem to be outpacing. So it's one of those key areas to say, how best do we do it? From an expenditure perspective, I realize that there are also external factors that have affected us. For example, the withdrawal of US aid. In this case, I've given African economies that were dependent or that were benefiting from the US aid. And Zimbabwe, in 2024, I think we received roughly about $340 million. But I've given a trend analysis in terms of the US aid and where most of that has been directed towards health, humanitarian, and maybe a government aspect. So what it means is the declining of or withdrawal of part of this US aid. It means it will exert pressure on the government fiscus. So it's one of the aspects that we see coming through to say, if this US aid assistance is significantly reduced, it again puts pressure on the government to say, how best do you accommodate that aspect of the spending pattern? Having said that, I've also gone further to say, from an expenditure perspective, why am I focusing on expenditure? Because I've noticed that, yes, revenue have done well, but expenditures seem to be adamant. They seem to continuously outpace our revenue. And I've tried to disaggregate our expenditures by employment costs, then other costs and capital costs. Why am I trying to do this? The idea is to say, how best where should we be cutting? And when you look at the employment cost there, at about 50% of total expenditure, it's quite significant though. We have made significant progress. At some point, employment costs were above 70%. So having come down to 50, it's a positive that is coming through. But again, from the expenditure disaggregation, the idea was to say, how best do we curtail part of the expenditures that are problematic to the budget? So I've just tried to use numbers to say, given the trend analysis, where should be our focus? Because we have seen that expenditures are becoming an issue in terms of going forward. I've also tried to look at government, roughly government salary scales over the period of time. And we know that at some point in time, salaries ranged between $300 and $800 for government. But they've come down. And also the analysis in terms of the currencies that we've seen. And right now, maybe salaries around 300 to 500 as the range. And we know that I think there's so much pressure. So in as much as we are talking about revenue, there's also so much pressure from an expenditure perspective. So this was just to try and appreciate the salaries the trend for civil servants. Having said that, I went to domestic debt, where we have seen a significant growth of domestic debt. And I saw that government made significant payment for compensation for white farmers. But I think when you look at the domestic arrears at 1.3, I thought that is a point to focus on, to say how best do we address these arrears. And these arrears, they cover the various aspects of the economy. So once a lot of these sectors begin to be affected by these arrears, there's a negative knock-on effect on other sectors. So we think that the arrears is a challenge. When I look at the treasury bills, they constitute almost 379 million there. Again, from a business perspective, I think when these treasury bills mature, the idea is to say most of the maturing treasury bills have not been timely honored, and that has put on a cash flow strain on a lot of these businesses. So we've been watching in terms of the components of domestic debt and how various components of the economy are affected by the domestic debt. So in a nutshell, maybe that is what I can say about domestic debt. So having spoken about government revenue and expenditures, I went to say what is the amount of money compared to our GDP for most of the African countries, as well as what is the credit in the banks compared to GDP size. And as you can see, when you look at that growth trend analysis, Zimbabwe, M3 to GDP ratio at less than 10%, it may mean that maybe the tightening is too tight. Because ideally, money supply to GDP maybe should be above, when you look at the competitors there, maybe should be above 30%. So is it possible that maybe at this level of stability, the liquidity conditions are extremely tight? I'm just trying to pose questions and maybe hopefully from that trend analysis to see is this the best, how can we intervene, and from that perspective. Credit to GDP in developed countries, credit to GDP is above 100%. What does it mean? It means businesses are able to access credit. In our case, credit to GDP at below 10%, it means a lot of businesses may not be able to be accommodated in the banking sector. And that becomes a problem because if you want to sustain economic growth, you want access to credit by businesses. The fact that we are lagging by these parameters may speak to some realignment to say how best do we align ourselves so that businesses begin to have access to credit in our system. Having said that, I went further to say, let me make a comparison between Zimbabwe, Mozambique, and Zambia. So when you look at GDP size, I've spoken about it to say GDP size, we are almost twice as big as Mozambique and Zambia. But look at the deposit level. Deposit for Zambia is $8 billion. For Mozambique, it's almost $12 billion. For Zim, $4 billion. That becomes a problem. So what it simply means is we could be having significant amount of money outside the formal banking system. The problem with that is that when you look at our credit at 2.5 for the size of the economy, it means a lot of businesses are struggling to access that credit when you make a comparison with our regional counterpart. And I've said, what is our proposed? Proposed simply says, maybe what that should be our preferred target. When I take account of the indicators of credit to GDP and deposit to GDP for Zambia and Mozambique, roughly what it simply means for me, because it gives us an indication to say how much do we need to work on so that we attract as much deposit in the banking system as we can. So in my view, preferably at a size of $53 billion, our deposit base should be around $20 billion. That's what this is saying. Our preferred level of deposit should be $20 billion. And our preferred credits in those ratios should be close to $9 billion. So what does it mean? If our credit is about $9 billion, it means more businesses are able to access that credit. So in this instance, I want to believe that whatever alignment that we need to look at, it should also incentivize growth of those deposits as well as growth of credit, because it's from that deposit base that we are able to do that. Having done that, I went further and said, if I look at top 3 banks in Mozambique and top 3 banks in Zimbabwe, what is their deposit level? Top 3 banks in Mozambique, deposit base is $8 billion, more than the entirety of our banking system. So I think size matter, because if we are smaller, we are not able to influence. So when I look at the top 3 banks in Mozambique, they have a deposit base of $8 billion and total loan book of almost $2.5 billion. Ourselves, top 3 banks, roughly about $2 billion and a loan book of $1 billion. So I think given the size of our GDP, there's need for us to say, how do we realign ourselves? And when I look at the level of branches, those 3 banks, they have almost 450 branches. Ourselves, about 65 branches. Number of ATMs, 1,260, vis-a-vis 110 for Zim. Of course, I think on number of POS, we are almost in the ballpark. So I think for us, when I look at these dynamics, in as much as I've spoken about the fiscal aspect, the size of our economy, I believe there's need to realign so that our deposit base is able to attract the informal deposits that are circulating outside the formal banking. In that way, businesses will be able to access credit. Having said that, I think a lot of these also, we have spoken about them. When I look at the monthly ATM cash withdrawal, I know we have spoken about cash withdrawal. ATMs, on average, beginning of the year, ATMs, people were withdrawing almost 260 million on ATMs per month in total Zimbabwe. And that has grown. I think it's also signifying the growing economy and appetite for cash. And having said that, the cash withdrawal levy will significantly affect a lot of businesses. When I look at the bank's perspective, almost 20% of total income comes from cash withdrawal fees. So if that is wiped out, there is a danger of instability in the banking system. I've spoken, I will not bore you much about a lot of these things, but when I look at the individual cash withdrawals for both individual and corporates, on balance, banks would charge about 3% on cash withdrawal. If you add another 3% cash withdrawal levy, it becomes prohibitively 6%. So I think there's need for both government and maybe even banks to work together and say, how best do we lower those costs? Because if a depositor is looking at 6% withdrawal fees, there's no way we will be able to attract those deposits. Because remember, that's why I've showed us to say, this is where we want to go. From a deposit-based perspective, given we are a $4 billion deposit base, we want to be a $20 billion base. And with such prohibitive costs, it's going to be difficult to attract any deposits. So that will work against the growth that I've spoken about. I know we have spoken about ZIG US dollar transactions. I was looking at week-on-week RTGS transactions, which are disaggregated by local currency and US dollars. Those ZIG transactions that are happening on our platforms, almost 65% are in US dollars and almost 35% are in local currency. So this speaks to the fact that there's still significant transactions that are biased in US dollars. I've looked at IMT tax in terms of its contribution to the fiscus, and one can see, to say it's at our peak, IMT was contributing 11.3%. And maybe now it's below 5% contribution to GDP, to revenue, sorry. It may mean that increasingly the markets are that informalization is eating into that contribution. And businesses are trying to find ways of circumventing payment of IMT. And that increases informalization. Issue of VAT. I had done my projections before the budget, and I realized that US dollar inflation will most likely fall to below 5% in January because of the base effects. But when you impose the effect of VAT, there is a danger that that inflation that we were hoping for a lower inflation, it may mean that the VAT impact means that inflation will be slightly higher. And in the past, consumers have been at the receiving end, because every time there's been a policy that shifts the cost base, normally businesses, sometimes they can also include their profit margin. As a result, it's the consumer that suffers more, because that speaks to erosion of disposable income. And that VAT increase could have significant impact on inflation when we look forward. The royalty, I will not speak much about that. Maybe let me speak lastly on some of the indicators. We have enjoyed one of the consistent months of reserve growth, foreign exchange reserve growth over the period of time. At almost $1 billion, we know that our import cover is almost 1.1 months of import cover. But when I compare with our peers, you can see that Mozambique, roughly $4 billion, import cover almost 4.5 months. Zambia, almost $5 billion in terms of FX reserves, import cover almost 4.7. So this gives us also an indication to say, in as much as we have come from below $200 million in terms of FX reserves, there's still a long way. Given the size of our economy, I think it just gives us the impetus to say, yes, we are celebrating the success, but there's so much to be achieved given what other members of the region are at. In a nutshell, maybe those are my few snippets in terms of, I know I've spoken about the various aspects from real economy, manufacturing, banking sector, and other aspects of the business. So in a nutshell, without necessarily repeating some of the measures, maybe those are my snip view of some of the critical elements that I was trying to extract from the budget and see how it can guide policy as we go forward. I thank you with that.
Thank you, Mr. Wadi, for such an insightful and eye-opening presentation. And without taking much of your time, let me call upon our next speaker, who is the president of CZI, Mr. Much Mkanganwe. A round of applause for him as he comes.
Good morning, everyone. Honorable Minister, Professor Mthuli Ncube, and our PS for Finance, Mr. Gwamatanga, and I'll ride on the protocols that have already been established. James, thank you for that. You know, we've been working with James for many years, and you know, the data that he has is data that he's collected as a passion. And now if you want to know anything about where Zimbabwe has come from, he's really our go-to person. We appreciate that, that insight. I think the import of the conversation we're having is, how do we unlock this GDP? How do we get everybody to benefit from this GDP? You know, I hadn't seen James's presentation, but it has struck me that our numbers at 53 billion are very significant. And if I'm to be fair, Honorable Minister, I quizzed the IMF and the World Bank on how accurate these numbers are. And they're very accurate. It's quite remarkable to collect $8 billion in taxes. And I think we have to congratulate government, we have to congratulate industry, and all the other players for their efforts to get us here. When you look at the high-level numbers, if you are able to grow GDP, double it in 5-6 years, as we saw, that's remarkable. In my entire working life, and I started working in the early 90s, I don't remember a single-digit inflation. So again, we congratulate government for their efforts to getting us here. And below 5% in April. This is quite remarkable. Honorable Minister, I'm not going to have a very technical opening remarks because we've got a lot of technocrats coming up. I'll just talk about some of the high-level things that are concerning us right now. Ease of doing business, we welcome the ease of doing business efforts that have been led by the Ministry of Finance working together with the World Bank and in association with the stakeholders. We understand that there are transitional issues that may be arising, and we would like to see an allocation towards the transitional mechanism. We recognize that you know, overnight you're going to reduce the incomes of a lot of organizations. And if we don't manage that transition properly, if we don't put resources towards that transition, we may not get to where we want to be. We're keen to be part of that conversation if there's room for us, but we understand that it may cost money for us to do that. The conversation we welcome around de-dollarization. We welcome that. It's a key issue for all the members in the room, as I'm sure it is for you in government. We welcome the milestones that have been outlined. We would like to see those go into legislation. And we feel that the 2030 date might be a noose that we've placed around our own necks, which is not necessary. So we would like government to consider legislating the milestones and moving away from the date. Minister, we welcome the business-state partnership. And I've been seeing this grow every single year. I've been involved with advocacy for many, many years. And I can say without any hesitation that we do have a listening government. We have a lot of access. We have very robust conversations. And we look forward to a robust conversation again today. And I think you can see that with both the PS and the Minister here, how seriously they do take our opinions. Finally, Minister, we anticipate that now, with inflation where it is and capital markets starting to improve, we need to start thinking about deepening these financial markets. We've not really had any breathing space to do that. I remember when I started working, I don't even know how many financial institutions there were, discount houses, asset management companies, etc. And I think perhaps it's time to start looking at the infrastructure so that we start moving in that direction. We welcome the new stock exchange that's coming, but we feel there's more work that's required. Those are my opening remarks. Thank you everyone for attending, and we look forward to your contributions and inputs. Thank you.
Thank you, Much. Another round of applause as he... And without taking much of your time, once again, let me call upon the Bankers Association President, Dr. Sibongile Moyo. A round of applause as she comes.
A very good morning to you all, and what a fitting engagement to meet at as we end the year. I think what has been a very successful year for the economy and industry, and pertinent discussions that we're here today to have. Okay. May I ride on the existing protocol and acknowledge still my line minister, the Honorable Professor Mtuli, and our line permanent secretary, Mr. George Goa Matanga. I'm reminded of a famous anecdote that speaks to the reality that we're looking at today as we discuss the recently announced budget. And it's the fact that government programs and their budgets are indeed the nearest thing to eternal life that we will ever experience on this earth. So government programs and their budgets never end. So we will always be having these discussions, and in the spirit of idea generation and sharing, again, we'd like to point out just our perspectives and areas of intervention that have arisen from this budget as a banking industry. We welcome the announced increased allocations to agriculture, education, health, ICT, infrastructure, the renewable energy sector, and we're seeing great opportunity for banks with a much higher demand pipeline for funding, for project financing, supply chain financing, green bonds, and renewable energy funding projects. We saw a pipeline of about $500 million mentioned in the budget, so exciting times ahead if we can get our financing and structures right. So as banks, we play a crucial intermediary role. I've just outlined what we do. And I think we're best known for being agents of policy implementation and fiscal collections. So all your IMTTs and everything that you really love, all the taxes and charges are collected via us as your agents, well, as the agents to our principals, who are the fiscal authorities and the various line ministries. And this, I must say, has made us quite unpopular with the banking public. You know, a narrative that we'd like to reverse, but unfortunately we find ourselves as being at the center or the core, you know, of implementation. Now, is this, sorry, which one is it? in terms of areas of intervention that we're thinking that the ministry could look at, the policy longevity, and I've not spoken of policy consistency, we're talking about sustainability or longevity of the policies that we decide to implement. And I'll just mention briefly the de-dollarization roadmap, which has been mentioned already. I'm not going to belabor the point, but just to say, if we're looking at a market and consumer preference-driven approach, let this also bring to our minds the question of, if we say that the informal economy is accounting for 70% of transactions in the country, what does it mean to implement monocurrency in the formal banking channels, which are possibly accounting for only 30% of transactions in the economy? Now, as we speak of other levers from our authorities, the key one that comes to mind to me is the matter of our treasury instruments, which are key to facilitating market liquidity, market trading, redistribution of liquidity. And our request really is to restore the risk-free status of these instruments, to allow us to restructure maturities proactively so that we do not run into the matter of confidence issues. And also, we would benefit from a clear maturity profiling of our debt or our government debt and treasury instruments that separates our short-term treasury bills, which may be used in the money market and are possibly settled or restructured within acceptable time horizons. This should be separated from possibly treasury bonds, which we don't issue in this market, that allow longer-term horizon maturities, so that we have a separate book, separate maturity profile that's published and that's manageable to avoid the contamination and then lack of acceptability of treasury bills at large when it's clear that we have different tenure profiles between the short and the long term, whilst we need the short-term instruments to allow us to continue to trade and redistribute liquidity and fund industry effectively in the market. Now, in terms of banking sector viability, I'm sure you do not believe that return on assets and return of equity have fallen quite drastically over the reporting period, and we expect further reduction or pressure on viability in the industry. A lot of this is being driven by the informalization with reduced banking through formal channels, elevated fees and taxes, of course, and measures to reduce bank charges that we've already started implementing, including a number of you, our clients in the corporate sector, constantly demanding margin reduction in interest expense that you are paying to borrow from banks. We've seen a huge reduction in margins. We've seen a huge reduction in earnings, and we see this continuing and anticipate this will continue with the new measures that we see around increased fees and taxes, a lot of transaction-based fees that have been introduced, as well as taxes such as withholding tax on interest income or interest expense paid to lenders who may be offshore lenders, who may be deposit providers that fuel the funding capacity of the banking industry. This is just to illustrate the funding gap that we do have in the economy, which is quite significant. We've seen up to 1.96 billion of funding to the banking industry coming from offshore lines of credit. And this is already almost 60% of deposits in the market. My colleague, James Wadi, did give a very good presentation on our deposit capacity. And we're seeing lines of credit alone almost surpassing our deposit capacity in the market in terms of providing funding for much needed capital and, capital expenditure and working capital in the industry. Now, what we found is that taxes that have been touted against interest earned on these offshore lines of deposit providers have a huge and significant potential impact in increasing this cost of funding to a point where it may be unsustainable for industry to keep borrowing from offshore financiers whilst we're faced with a very limited market liquidity, which means that industry is going to be crippled or may be crippled in terms of funding. So again, we did discuss this matter briefly, but the significance of this, given the extent of funding coming from offshore lines, more than 60% of deposits, is a matter that needs to be looked into. As we're already suffering from reduced access to funding, we're seeing the tightened liquidity in local currency ZIG, which could have presented an opportunity for expanding credit, but with our tight liquidity stance, we do not have the room within the local currency to expand credit, and this is probably our only source of growth to provide adequate funding to you as industry. Now, the risks to financial intermediation are linked to the last point I made, tax deductibility of interest expense. Yes, we have a positive result with the minister announcing reprieve on this matter, although it needs to be extended to our most significant sources of funding in the banking industry, which are not just customer deposits, because only 10% of our deposits are interest-bearing in the market, whilst over 60% of deposits are provided through offshore loans to fund industry. And that is by far the most significant source of interest expense that needs to be subject to tax deductibility to make sure that we're able to lend effectively at competitive rates and to keep industry going. The matter of retrospective application has been mentioned already by my colleague James, as well as the CZI president. This is very critical. We're looking at an excess of $60 million to $100 million in potential tax bill on interest expense due to be paid by banks and all to be paid from current revenues from the retrospective application of this law to 5 to 7 years prior to 2025. Therefore, a prospective application from 1 January really does pose a viability risk on the industry. Why? Because at those levels, we're looking at capital even being impacted to below compliance levels, and levels that will not allow us to continue raising the funding that we do and to continue supporting you as industry. Again, on cost of equity, which is critical to banking sector's capacity, we found the reintroduction of withholding tax on dividends to commercial bank shareholders, which can become a significant deterrent to investment in banking stocks, on the ZSE, on VFX, and in general to investment in banks by the investing public as well as existing shareholders. We have a lot of positives in the budgets, reduced IMTT. Then we also have significant transaction-based taxes that are possibly going to drive us back into accelerating informalization. Now, I will not belabor the point, but our collective objective, especially as the Bankers Association, is to spur digital adoption and not drive consumers away from digital channels because of transaction-based fees. It's also to improve financial inclusion and not drive our customers to avoid or bypass banks inadvertently due to our initiatives. Yes, we are trying to broaden the tax base, but there are some unintended consequences and consequential losses that may actually take us backwards. We're already speaking of a 70% of transactions in the informal sector. That little 30% needs to be preserved and grown rather than to have it going backwards, due to a few trade-offs on our tax metrics that we possibly could look at differently. So, what are the opportunities for us as banks to support the productive sector? I think, Sekaya, you asked me. Look, the key issues that are coming out of the budget are around the mining industry, where we're funding to quite a significant level. We've been approached by our clients on significant mine development projects, and already we're looking at viability concerns and credit default risk, considering the reduced free cash flows from increased, from disallowance of tax deductibility of capex expenditure, current capex expenditure, which means that any cash flow that was available for increased capex has also to be committed to taxes in the current period, whilst you spread the capex allowances over life of mine, which drastically reduces project viability and free cash available to our clients. We are seeing credit default risk coming in to play already as we've rerun models for our existing book. And we're also seeing with the gold royalties proposals, significant reduction in free cash flow, because this is not even on a reducing scale. You're seeing the ramp up to 10% royalties for the entire price range. It's not beyond the 2,500 benchmark. And in fact, it's probably leading to the putting in on the shelf of some significant mine development projects which are critical to our economy, because as we speak, we do not have a single senior miner in this country, senior gold miner in this country, despite us having the richest or some of the richest and low-cost gold reserves in the region and even in Africa. Why? Because any mining development or industrial scale mine development in the face of lack of capex allowances for tax, increased royalties, already becomes an unviable proposition. Mr. Mseku, I see nodding to that. Yeah. So again, in export agriculture, we spoke about the blueberry industry earlier in the closed session. We spoke about plantations, completely reliant on offshore lines of credit. We're speaking of 750 million just to get the horticulture industry getting to where it needs to be as a billion-dollar industry. And that offshore line of credit, given the withholding tax proposals against the interest expense, makes this much more expensive, at least by an additional 1.3% per annum, in an industry that's already failing to harness concessionary funding for its growth. So as I wind up, again, our requests are around the issues or the matters that I've already mentioned. I will not belabor the points, but it's just to say we must relook at our interventions in a holistic manner and look at what we need to sacrifice in the short term to allow mine development, to allow horticulture industry development, to increase formalization in the economy, to bring more of our customers into banks, and at the same time, rather than push them more into informality, because this is the only way we'll be able to achieve real economic growth. If we can account for all the transactions or all the economic activity in the market. So, Honorable Minister, sir, these are our remarks. I know that we do engage quite frequently as an industry with you, but I thought to share with industry who do not have much deeper insights into our operations a little bit about where the budget puts us in terms of our day-to-day operations and the outlook.
Another round of applause for Doc Moyo. Thank you, Doc, for the remarks and the requests. Now, when the minister said that our GDP will close the year at 53 billion, and we are going to have another 5% growth in GDP, that will take probably our GDP to about 60 billion next year. So the question on many people is that, is the economy really growing? And from a private sector point of view, we are going to hear from Tinashe Mkogo, who is going to have an analysis and answer the question, is the economy really growing? A round of applause for Tinashe as he comes through.
Good morning, everyone. So just to recognize all the distinguished guests and everyone who's come here today. So just by introduction as well, so my name is Tasha Mkogo. What I do is I wear many hats, but one of the things that I also do is I research and write and publish on what I call the most important companies in Africa. Typically, that is listed companies, and I typically do that twice a week or so, so I've published over 100 pieces, a lot of them touching on Zimbabwe specifically. And that newsletter is called Money and Moves, which is what I'll be talking to you a little bit about today. So, the first question is, why should we use, or what's the utility of listed companies when it comes to analyzing the economy? Well, first of all, an economy is basically made up of economic participants. And so if you look at what's happening with the economic participants, you should get a feel of what's happening in the economy. Number two, listed companies are typically, very influential players within an economy, oftentimes the market leaders in that particular sector that they are in. And while they don't necessarily represent the informal sector, they often do actually serve the informal sector as well. Then the third thing is that you get high quality frequent data. So listed companies typically have to publish 4 times a year. So you have your trading updates, your interim results, you have your annual reports, and their results are audited. So you get a pretty solid numbers that can be kind of challenging to get, in many African contexts. Now within this context, there is one company that I find particularly interesting to look at when you're trying to gauge economic performance, and it is Delta Corporation. There probably are some people from Delta here. If I say something that's not nice, please forgive me. So this is how Delta makes their money. So about 40% from beers, 26% from non-alcoholic beverages. That's actually gone up because of the Schweppes acquisition. Sorghum-based opaque beer, Chibuku 26%, 7.9% wines and spirits. And the significance of this is that it's very hard to go a day without interacting with at least one of these things, right? And so it's a very useful reference point to have. Now, the other thing that makes Delta interesting is this is the Zimbabwe's Magnificent Seven, right? Which we've had over the time. And this basically shows the largest companies by market cap in US dollars for the last, I think, 15 years. And as you see the top bar, you will see that Delta has been bouncing between number 1, number 2, number 1 and 2 over the last 15 years or so. So that just highlights that it's really a company that has been at the center of the economy in one way or another. And as of 2025, year to date, this is what it kind of looks like. So the usual suspects you would expect to see on this chart. So having understood all of this context, one of the things I started to do was to try to go back and look at all of Delta's numbers. And so what I did was to take 20 years of Delta's volumes, specifically looking at their clear beer, sorghum, and their sparkling beverages. And what you'll see here is at the bottom we have the GDP of Zimbabwe from the World Bank data. This is real GDP. I've also done this for nominal GDP as well, which I'll show you. And at the corner there, you see that there is a R for the statisticians, which basically means that the correlation between these two numbers is actually very strong, right? And if you're not a statistician, you can also just look at it and it makes sense, right? So 2008, we know we had hyperinflation, so we see the big drop-off. Then we know when dollarization happened, we had a sharp increase. Then according from 2012 to 2015, things kind of started to slow down a little bit. Then of course, when COVID happened, we had the big drop. And what you'll then see is that there's been a sharp rise recently. And interestingly enough, when you then consider, and I'll jump to the next slide, when you then consider the rebasing, which if you look at it from a GDP perspective, looks awkward, but when you see Delta's trend, you kind of see that actually sounds kind of right? That 44 or so. And so This is not perfect, for sure, but the idea is that, you always want to try to have as many data points you can have to get a picture of what could be going on. So we've had a lot of the macroeconomic picture, and I'm just trying to drill into a lot of the hardcore numbers at a company level to see if there is a trend that we can pick up with regards to whether the economy is growing. Now, if our hypothesis holds true that Delta is a good proxy for what's happening in the economy, then it makes the latest numbers very interesting, right? So what you see here is the latest numbers from Delta. And by the way, just in case there's Delta guys here, if you didn't recognize the numbers in the previous slide, it's because you have a March year end, so I had to normalize it so that it's a Jan to December comparison for the GDP. Because I know I've been asked questions on that before. So this is Delta's latest numbers that we see here. And the highlight number is that 18% growth in volumes. In USD, revenue was up 21%. It was actually up 32%, but then there was also the acquisition, so we have to back that out. So we get the 21% for a like-to-like comparison. And I've included the volumes because I've also had people say that maybe this is inflationary growth. So I've had to put the actual volumes to show that this is not just inflation, this is actually real growth that's been taking place. And to put this into further context as well, if we look at AB InBev, which I think still owns a part of Delta, actually. They're a beverage maker, and this is what they said in their most recent results. So in South Africa, our volumes grew by low single digits. That's typically 1 to 4% when they say that. In Nigeria, beer volumes declined by high single digits, right? So you're talking about 9 to 10%. And then in other markets, the volume grew by low single digits, driven by Tanzania and Mozambique. What that probably means is that there were some markets that had some growth, but a lot of them were flat or negative as well. So putting that into context, you have a situation where other markets are actually growing negatively or flat, and we have 18% growth in volumes. That's a lot, right? Now, obviously, if our theory holds true, it's not just enough to see that growth in Delta's numbers, right? Because that wouldn't make sense. So if you go back to our Magnificent Seven, if you could call it that, this is the volumes or the revenue growth that they've just reported on most recently. So 21% is Delta, which we'd mentioned, right? InScore, I've shown the 30 June number. They have got recent results that they've reported on as well, which also shows very strong numbers. I just don't think they gave us the actual US revenue growth because it was only a quarterly update. Econet, 38%. Worth noting that is based on hyperinflation accounts. So all the others, I think, are all USD reporting. So hyperinflation accounts, there is a little bit sometimes some variability in the numbers. But if you look at their underlying growth, also very, very strong. Even better than what they were doing in that 2015-16 stage. And then we've got Caledonia, we all know, 52%, Padenga, 38%, West Property Group, 32%, and Simbisa, 16%, and that's just for Zimbabwe alone. If you actually add back all the other countries that Simbisa operates in, because I think they're in Kenya, for example, it actually drops, which is another example of how within Zimbabwe, it seems there's a lot more growth than actually in other markets elsewhere. Now, where's this growth coming from? If you take the two biggest growths, right, excluding Econet, of course, it kind of gives the, part of the reason away. We know we've had record gold prices and gold deliveries, so two tailwinds, so very high deliveries, as well as very high gold prices. And this is a blessing and a curse. The blessing being that I think next year Goldman Sachs is forecasting that the gold price could get to about 4,900. So that's a blessing. The curse being that, it's something that's out of our control. So if it then drops, then, what then happens in that case? And then you see at the bottom, this is another company, TSL. This is an extract from their most recent results. They say that the 56%, so their volumes, tobacco volumes were up 56%. So another really, really strong result. And what you see there is just the picture of everything put together, which is Zimbabwe's export growth, which I think is on track to get up 23% this year. So pretty much very strong numbers across the board. Now, what's interesting is that this is the obvious stuff, so to speak, or the stuff that we can see. But when you go through the company results, so what I did was I then took a sample of all of the companies' results, and then I tried to read through what were they saying were either driving the economic growth or the risks that they were seeing, right? I couldn't do all of the companies because some of them had to be taken out because they didn't have recent reporting, or in some cases, like for companies in distress, it might not necessarily make sense to put that into the sample group, but it did cover nearly half of all listed companies. And this was number one topic, and actually in this case, a favorable point, which was macroeconomic stability, exchange rate, inflation, i.e. 84% of companies mentioned this as something that has been helpful in terms of operating and driving the growth that we have been seeing. So it's fascinating because this is was even much higher than the gold topic we talked about, much higher than the agricultural output, which we'll see where those came in. So gold was at about 39%. But the thing that companies really appreciated the most, more than the tailwinds from agriculture, more than the tailwinds from mining, was just stability. Stability was the most favorable comment that was made. And then the biggest risk was actually liquidity constraints as well. There was obviously other topics like power utility disruptions. A favorable topic, of course, we talked about the mining performance. Interesting enough, informal sector was there, but yet again, stability was the number one thing that companies were talking about as well. And then, of course, infrastructure topics and taxation as well. So, what do we conclude from this? Now, I rely on data, and so if I look at the data we've seen in terms of the growth of the economy, in terms of the growth of companies' performance, I know for a fact that there are some companies that haven't grown as much, of course, but if we look at the broad trend, the economy is definitely growing. And I'm actually going to put a bet that the growth this year may actually be even higher than the 6 to 6.6% that's being projected. I am not an economist, by the way, so I could be wrong, but I'm just going to bet on my own Delta KPI and say that with the growth that we're seeing there within the N-scores, within the Econets, I think this could be a year where we even grow above that 6.6%, which is what I think is the higher bound that's been discussed so far. That's conclusion number one for me. Number two is that key sectors have a big role in terms of shaping the economy. We did see that the upside that came from gold, from the mining industry as well from the agriculture industry, seemed to seep through the entire economy. And so identifying those sectors that have a real important strategic factor for the economy and supporting those is really important to do. And the third thing is that stability is key for continued growth. From what we're seeing from the companies, the thing that is really going to be important is trying to get as much stability as possible. The companies seem to be showing that given the right conditions, companies in Zimbabwe can do extremely, extremely well. And now that we look at our GDP being at that 45, 50, maybe 60 billion level, I think there's an element where we need to start to also being leaders within the region. One of the, I don't want to call it lowlights, but one of the key trends that we're also seeing is that for whatever reason, companies are struggling to perform as well outside of Zimbabwe. If you look at Delta's results, their weakest operations were the ones outside of Zimbabwe. Simbisa, the same situation. And if you look through all of the listed companies, it seems to be a trend. Part of that might be because of the high cost of capital that's here. It might be because of overly focusing on at home to try to make sure that you responding dynamically. But all things put together, I think there's a massive opportunity, and we really are at a point where, with the right stability, with the right environment, 60, 70, maybe even 100 billion is within reach within the next period of time. I don't want to put a number on it as such, but thank you. I think that's it, and yeah.
of applause for Tinashe. Thank you, Tinashe. So, is the Zimbabwean economy really growing? Whether you agree or not, the minister wants his pound of flesh. And that pound of flesh, what sort of implication will it have on the economy once again? So to help us unpack the tax competitiveness of the economy policy and strategy is Harriet Green-Thompson, who is going to talk about, who is a tax advisory consulting. Harriet, over to you.
Honorable Minister, distinguished delegates, all protocols observed. A very good morning, everyone. I have been asked to talk about the taxation competitiveness of the economy, given the recent tax proposals which were announced in the national budget. I will examine the tax measures as announced and assess their impact on the business and the broader economy, bearing reference to our peer countries in terms of how taxation has impacted their economy. I note the speakers before me have talked about the tax issues of concern, and I will just run down some of those tax issues. But before I talk to the issues of taxation, the topic talks about tax competitiveness. And when I was preparing for my presentation, I was thinking, when we talk about tax competitiveness, just to give you highlights in terms of, or insights in terms of what tax competitiveness talks to, it will talk to the stable rates. It will talk to things like incentives or exemptions granted, an efficient tax administration, the regulatory framework, adherence to international tax rules, predictability and transparency. I think those are some of the key elements to consider when we're looking at the tax framework. I guess my task today is to examine whether our tax system, whether the proposals as announced by the minister are opening doors for the business or they are closing the door quietly, if I may say. I have a slide there. These are the results from the Revenue Authority as of December 2024. These are the taxes which were collected by the Revenue Authority. And the reason why I have highlighted that slide, I think just to give you a perspective in terms of the revenue contributions overall for the taxes. I think what we see there is we have VAT, which is the highest contributor. It contributed 30%. And by the way, that's an extract from the ZIMRA report, so that should be factual information. So VAT contributed 30%. We also see IMTT, which is also an issue of debate and discussion today. We also see IMTT with 8% contribution. Excise duty, 11%. Mining royalties, again, which was one of the issues which was discussed in this year's national budget, it also contributed 3%. These are the stats as of last year, December 2024. And I'll keep making reference to these stats as I go through my presentation. So those are some of the key tax highlights. Obviously, there were a lot of highlights which came through this, the national budget statement this year, but I thought it fit that we discuss some of them which seems to be having a biggest impact and concerns coming from business. So the first issue, which have been discussed by the speakers before me, is the issue of the increase in VAT from 15 to 15.5%. There is a reduction on IMTT, deductibility of IMTT for corporate tax purposes, the reintroduction of 15% non-resident tax on interest payments. By the way, this legislation was there before, I think around 2009. It was repealed. We see now in the budget statement that it has been reintroduced. An effective increase in gold royalties by the introduction of a sliding scale of up to 10%. The limitation on assessed loss carried forward by minors, which has been restricted to 30%, and the migration, the proposal talks to a migration from rebate-specific incentives to suspension of duty, which again will talk as far as the impact is concerned. And then a domestic minimum top-up tax for high-earning foreign multinationals within a certain threshold. And of course, the budget speech also talked about tax incentives, which were announced. So let's start with VAT, the increase in VAT. And I think we, from a fiscus point, that 0.5 increase in VAT will boost the revenues for the fiscus. And I think where we see the 30%, which you saw in that diagram, obviously in 2026, as this increase is effected, the revenues for the fiscus are likely to go up. But what does it mean to business? Business, and I think what we see, by the way, I'm not an economist, and I think what we're seeing is, I think when you're assessing the impact of the increase in VAT, chances are business are likely to pass on these costs to consumers, so the end consumers are the ones who feel the biggest impact. And I think just to look and compare with other countries, and I just put 2 or 3 examples there. When we look at South Africa, the current VAT rate in South Africa is 15%. And I think of interest is I also noticed that sometime this year in 2025, the South African government had also proposed an increase, but this was from 15.5%, I think, to 16.5% effective January of 2026. But what we see is that increase has since been reversed. So South Africa is on a VAT rate of 15%, Botswana 14%, and I think in my comparison there is Malawi, there is Namibia, other regional countries. But the ultimate effect is really on the consumers, as I said. I think that increase there, what it means is just there is a suppressed demand as far as goods are concerned and goods and services are concerned. And what is also likely to happen is we see consumers maybe seeking for cheaper alternative goods or services from the informal markets to manage budgets. And I think it's really what, in the end, what the minister is seeking to achieve by raising the 5%, by raising VAT to 15.5%. We don't know whether the ultimate result will prevail, because when consumers choose alternative or source goods from the informal market, it means that there is loss in revenue to the government. Then IMTT deductibility and the rate reduction. Again, this is a very welcome development, given the concerns which have been coming from business. I think just from a comparative analysis, what we note, countries like South Africa, Zambia, Botswana do not have the IMTT framework embedded in their tax framework. There are some aspects of it under digital service tax, but not specifically IMTT. I think that goes when you are now comparing to say what is happening regionally. The proposal to reduce IMTT, I think it's for ZIG transactions can be a growth orientated reform as it lowers transaction costs. But I think the speaker before us talked to, as far as the banks are concerned, ZIG transactions translate to 35% of the bank's transactions, and USD transactions 65%. So whether this reduction has a positive impact on business, on consumers, I think it remains to be seen, given the use of the USD, which seems to be more prevalent than the ZIG. Again, I think when you talk to business and consumers, they might not, as far as the reduction of IMTT, they might not feel it because it's coming together with the increase in VAT. So we have the reduction in IMTT, whether that translates or the business or the consumers will feel that reduction in IMTT, it remains to be seen. I talked to the reintroduction of 15% non-resident tax on interest payments. And I think the Bankers Association also talked about that. It's an issue of concern as far as banks are concerned, as they are withholding tax agents or agents of collection for the withholding tax. I think from a tax point, I think what we foresee with this introduction of this withholding tax is most likely that foreign investors may shy away from financing Zimbabwean borrowers. And ultimately, they may end up just passing on the costs of the withholding tax to the Zimbabwean borrowers, which again then increases the cost of doing business in Zimbabwe. I think that's what we ultimately see as the impact of the reintroduction of that withholding tax. I will talk to gold mining royalties. Of course, I think to government, the issue of gold mining royalties, that is an immediate revenue boost as far as the mining royalties are concerned. However, I think when we look at business, this is something which is coming at a point when gold prices are high, and most of the miners are likely to be impacted with the 10%. There's a threshold which is ranging from 3 to 10%, and given the gold prices currently, what it means is that businesses have to go back to the drawing board, reassess their financial models, their budgets and their forecasts, and do a potential reassessment of the viability given the increase in the royalties. Again, to miners, there is also the aspect of the limitation on claiming of capital redemption allowances by miners. Just a recap for those who might know, miners are or were allowed to claim their capital expenditure in full in the year in which they incurred the expense. So what it means is by this proposal, which has come through to spread the capex over the useful life of the asset, there are obviously delayed tax deductions, which potentially strain any projects which are currently in place, and also impacting on the cash flows to the sector. It may result in deferred investment as older machinery remains in use, as miners are not seeing the immediate benefit of reinvesting in capex. I think what we see is that the issue of, also when we're looking at the miners, there was an issue of assessed losses, which the minister talked to in this budget, where there is a restriction on the assessed loss which can be carried forward for the miners. Previously, miners were allowed to carry forward the assessed loss indefinitely. So the capping of the assessed loss, I think, For us, when we look at it, it was a competitive advantage for Zimbabwean miners, which now has been removed, and miners need to reassess the impact of such. The new digital service withholding tax, which was announced or which was proposed, there is a proposal to introduce a 15% withholding tax on offshore digital services in place of VAT on imported services. I think as far as this is concerned, South Africa, again, we did a comparative analysis for South Africa, Zambia, and we do not seem to see this tax being imposed on foreign digital services as a withholding tax, but it comes in other forms. Again, I think when you look at it, because it's coming where contracts are already in place, which were negotiated based on certain fundamentals. So what it means is that when this tax is introduced, we anticipate that the foreign service providers are likely to just pass on this cost by increasing their prices to Zimbabwean customers. I think that's one of the negative impact which we see as far as this tax is concerned.
What, 3 minutes left? 3 minutes left.
Okay, thank you. And also, I think companies then, given the backdrop of this withholding tax, companies may also get restricted services from the foreign suppliers. Customs duties. The minister has proposed to remove sector-specific rebates and in place introduce suspension of duty on certain industries. What it talks to is under the specific, under the rebate regime, importers would not pay customs duties, they would not pay VAT. Under a suspension of duty, duty is suppressed, but VAT remains payable. So I think from a government perspective, it means that when we talk of VAT, which is now payable on importation, this will boost government revenues. But what does it do to businesses who previously enjoyed this rebate and who all of a sudden are finding themselves being asked to pay VAT on importations? It's an additional cost, and again, it impacts on cash flows for the businesses. I've talked about the deductions, I've talked about the increase in VAT rates, but there is also tax incentives, which were also pronounced in this budget. I think the tax incentives talks to double deductions for those in the film industries. They are going to get a double deduction. The 24-hour economy incentives, which are there, the KPO, BPO incentives, again, which have been also introduced, extension of tourism rebates of duty to the tourism industry. Again, this is a package of incentives which have also been embedded in the national budget. So I think just to briefly run down that analysis, when we look at our peer or neighboring countries, I've just put up the corporate income tax rates there for the other countries. There's been no changes as far as corporate income tax is concerned for Zimbabwe, but I think it's just to give you a perspective of what the rates look like in the other countries. And I think when we look at Zimbabwe there, I think we're not doing too bad. We are somewhere in between. And I think I can safely say, based on that, that our CIT rates appear to be competitive. In that diagram there, I've also included just a comparative analysis between I think the key tax elements which we were discussing, the VAT, the IMTT, the mineral royalties, and the corporate income tax rate, just to show you between South Africa, Zambia, Botswana, and Malawi, what the rates look like when you are doing a comparison. Obviously, it's not only about race when you are looking at, tax as far as countries are concerned. There are a number of other factors which will impact on the determination of the rates by government. But I think just to look and like for now, that's what it looks like. VAT, we are on 15.5% as of 2026. Zambia is 16% currently, Botswana on 14%, Malawi on 16.5%. IMTT, I think I talked about it, that we don't seem to have any other country which is charging IMTT specifically. Gold mineral royalties, yes, in other countries they have, and they are determined differently as far as the royalties are concerned. I think what we see there is on Malawi, is a 5% mineral royalty. Zambia uses a range between 5 and 8% depending on the type of mineral. So that's a high-level overview of the taxes as they appear in other countries.
Thank you, Harriet.
Okay, thank you. Just 1 minute. So I think in conclusion, the topic was the tax competitiveness. I think given the measures which have been announced by the minister, given the comparative analysis which we have done, I think the question which still remains is, do we believe that those measures are promoting businesses, are promoting economic growth? I see there is a give and there is a take, and I think ultimately it remains to be seen and assessed what the impact of those taxes will have on business and what they will have on the consumers. Thank you very much.
A round of applause for Harriet. So those who would want that presentation, maybe you can get in touch with CZI or Zim Papers, and you'll be able to get that presentation for the areas that she might have left out there. Now, when I was sitting there, I received an email in my inbox, and it was saying Zimbabwe's gold exports for 10 months to October 2025 soared by 88.9% to 3.7 billion from 1.99 billion and the same period last year. So now, I realized that when we were having the briefing earlier in the morning, we missed out on the miners. We didn't hear the miners' voice in that briefing. So I'll be extending a 5-minute presentation from Mwenewe Gold, the Chamber of Mines CEO, Isaac Kwesu. Your floor, sir.
My eyes ride on the protocol already observed, but special recognition to the Minister of Finance, Honorable Professor Muturi, as well as PS, or other invited guests. Thank you very much to give me a short slot to give a commentary on the 2026 National Budget Statement announced by Minister of Finance. By far and large, as a Chamber of Mines on macroeconomic issues that other presenters have allayed, we agree, and it is our hope that the macroeconomic stability and economic growth that the country is experiencing will continue in the future. Yes, there are certain risks that can undermine these growth prospects across all sectors. We have heard a lot about other sectors, manufacturing. Maybe we hear more on agriculture, but here I just want to touch on mining. Mining has been one of the magnet or catalyst for economic growth. we are happy in as much as there may be a feeling that mining may contribute more to fiscus. We also agree it's our feeling that where we're able to, we should contribute as much as possible, but let us not lose focus that the role of mining is more of catalytic growth. When you compare with other jurisdictions world over, mining, when it comes to contribution to GDP, it ranges between 9 to 11%, and for Zim, I think now we are one of the largest contributors, well above 14%. In terms of revenue contribution, again, when you compare with most jurisdictions, mining contributes plus or minus 7 to 10%. But for Zim, I think we're around 20%, which is a big plus. When you compare our contribution to GDP, around 14%, from that share of 14%, but we are able to contribute near 20% to COFAS. It's a good number. We may have other feelings, but from my analysis, it appears the contribution is not bad. We want to contribute more. Yes, when we experience super cycles in terms of gold prices, the feeling is we can contribute more, and we share the same views, but up to a point where there's optimal levels that our minerals can contribute. So just commenting on a few takeaways from the budget, which may undermine the contribution of mining, not just to GDP, but also to even fiscus. The Laffer curve in economics, you always have a point. The maximum percentage you can level on a tax is 100%, but at that level you get zero contribution. People will not go to work, companies will close. So there must be a limit. So I would start with royalties. Yes, we had previous speakers talk about gold royalties. Just our research statistics reveal that majority of royalties in the region, continent or global, they range between 4 to 5% average. Our review from an upper limit of 5 to 10% means Zimbabwe is the highest. In SADC, Zimbabwe is now the highest in the continent. Zimbabwe is among the highest in the world. Just to mention a few countries, South Africa is 5%, Ghana 5%, Tanzania, which is another top, 6%, Uganda, why I mentioned Uganda, because they now have a refiner. You can find your gold there, it's 5%. DRC 3.5%, Namibia 3%, Zambia 6%. Any movement of royalty from our research, 1% above median, you lose it. There's what we call osmosis of gold. It will move from high concentration of royalty to low concentration. So it finds itself in those countries where the royalty is relatively low. We can't control it. Whether we have police, whether we have army, we have whatsoever, because of the fungibility of gold. So, Honorable Minister, there's need to review this. Even the upper quartile, those who have the highest royalty, it's 6%. The mean average of the upper quartile range is 6%. The median, 4 to 5%. So we have to review this and able to not just compete, but we must be comparative. Otherwise, where they've high returns, gold just find itself being sold there. So our fear is not just viability, but also breed of side marketing with this royalty rate. So we need to review it. Yes, let us increase it, but up to the point where we don't react and reverse when there are no deliveries to fidelity. Let us avoid such situation. Otherwise, it won't serve a greater purpose. The other issue that covered by the speakers, which I agree, I don't want to waste much time, the issue of carryover losses. World over, it's not an issue of competitiveness, in as much you want it, but just being comparative with your peers. World over, majority is indefinite losses. You carry over indefinite. Limit to 30%, what does it mean in terms of capital? Majority of mining project, mining is capital intensive, it has a lot of what we call pre-production cost. So it's inevitable that we have to incur losses at the beginning. But if we want to encourage miners, they must be able to shield tax or to do something during those times of carryover losses, that they must be given incentive, a guarantee that you can carry over these losses, commit your investment. We know it's not easy, but you make losses, but those losses, we can do something about it, just like what the world do. So I don't want to repeat on this, but the issue of carryover losses, limited. It has an issue of huge capital outlay at the beginning, which you are not able to recover or which you are not able to hedge against paying taxes. The issue of repeal of the capital redemption allowance for miners may be up to the life of a mine, as opposed to accelerated depreciation. It has also a lot. Under normal circumstances, as we know, mining's long-term, its gestation period can go 20 to 30 years. So when you incur items that are short-term in terms of the life, 2 to 3 years, majority, trucks, drill rigs, front end loaders, including IT, the IT equipment, just a computer, you have to carry over it up to 30 years. I'm not sure, depreciate it for 30 years, a computer. These are some things that we have to maybe, Minister, review, align it, not just with best practice, also compare it also with manufacturing and all others, just to make it fair. The other issue, Minister, which I want also to put across is the computation issues surrounding beneficiation. We subscribe the government policy of beneficiation. We agree. We have no problem with that. Let us encourage, where possible, penalize. But the penalty must be computed in a way that is fair and justifiable. I'll just touch on 3 minerals. One is lithium. The second is chrome ore, as well as the granite. In your budget statement, these, in terms of computation of beneficiation tax, they'll be computed on manufactured or processed end products, which the miner does not sell. The miner sells concentrate, sells ore. So the money that he receives is the money coming from the ore or the concentrate. So why can't we charge them on the money they receive as opposed to the money that they don't receive? To a certain limit, if you go beyond a certain threshold, it means their beneficiary tax will be above their revenue, and it won't be viable. We've seen it with the lithium concentrates, where the beneficiary tax is charged on lithium sulfate or lithium salts that are manufactured in China. The price of concentrate is maybe around 8,000. The price of the lithium carbonate or lithium sulfate is around 80,000. And you are charging them on 80,000 as opposed to 80,000, which is 10 times. And the effective royalty is now around 40% on gross revenue, which will make this project not viable. So we need to revisit this. The last issue, Minister, which I just want to touch on, is also the issue surrounding the corporate social investment on coal, which you said is 2% on gross revenue. This tantamount to another royalty, 2%. They've been paying a royalty which was reviewed last year from 1% to 2%, and the effective royalty is now 4%. For core projects, this is totally too high, and it may not be viable. When you compare with other royalties in fossil producing countries, you can see the range between 1% to 2%. Our view is CSI is voluntary and must not be charged discretionary in form of tax. And we may need to review some of these thresholds to make sure that we align with the best practice and make sure we remain a competitive mining jurisdiction when you compare with the rest of the world. These are a few takeaways that I thought maybe we can share. We have sent our comprehensive position regarding the budget statement to your office, Minister, which have more issues than what I've just allayed, but in the interest of time, I'll take it that as a miner, our mining industry is really there to support our socio-economic development agenda of the country. Let us make it grow. Let us make it contribute to fiscus and to everything in the way that is able to do. The future is more important as mining is long term. Let us not destroy all the effort that people in the mine industry are putting, including government, when come up with enabling policies. So, Minister, I would like to thank you for your listening and hope we'll also be able to get some reviewed in terms of these issues that I've just touched on. Thank you very much.
Thank you, Mr. Kwesu. So we have heard from the miners, they have spoken. We have heard from the bankers, they have spoken. We have heard from the manufacturers as well. Now it's time for the minister and his team to respond and also explain some of the policy measures that were in the 2026 national budget. Let me take this time and opportunity to welcome the Minister of Finance, Economic Development and Investment Promotion, Professor Mtuli-Ngube, to give a response. A round of applause as he comes through.
Thank you. You may take your seats. Thank you very much. I'm going to do something. I'm going to ask the Permanent Secretary to speak first on one or two things. Do we have a roving mic?
Thank you, Honorable Minister. I think we'll speak maybe into the detail of some of the issues, and my Honorable Minister will address most of the policy issues. Yeah, so let's start with the cash withdrawal levy. So, Mr. Wadi presented a very interesting analysis, which is very similar to our analysis, that all the cash, or most of the cash, finding its way into the informal system actually emanates from the formal system. It's coming from the banks, right? So when you say that it will discourage banking, no, the money is already in the banks, but it's going out into the informal system and not coming back to the banks. And we have also said for individuals, if we withdraw 500 US, there's no charge. For corporates, withdraw 5,000 US, there's no charge. As a corporate, why would you withdraw? Why would you want to withdraw more than 5,000? Why would you want more than 5,000 US dollars in cash? So I think we've been very considerate. In any event, when you look at the revenue for banks, banks are making 20% of their total income from cash withdrawals. We've got the numbers, we've got the data. So maybe we need to find a way between ourselves, again, Mr. Wadi, as you indicated, and the banks, and say, how do we actually share all the 20%? But the issue is rather to discourage the migration of cash from the formal system into the informal system. Let's come back to the issue of 2030 on the issue of dollarization. The 2030 debt was never a government debt. I remember I worked on the SI and I argued that, look, let's not put a closing date on this SI. There was strong pushback from CZI, who said, we want a date. Then Takaisa date. Yeah, that's 2030. They asked for the date. But I think because we have robust conversation here with the Mucha, my brother here, he acknowledges that. And says, no, maybe now, got to say date. Minister, we might consider to remove the date. But it's not ours. It's not our date.
It's not our date.
We didn't place it there. The SI is not even ours. Right? The SI SIA was largely driven, CZI had influence, largely driven by BAZ. Don't have to know SI. It's their lawyers who wrote that SI, if I may tell you today. Then Mucha came with the date, BAZ did the SI, and we simply published it. But look, we will review as you indicated. On IMTT, I think the issue was always to say, what is the purpose of IMTT? Why did we introduce IMTT? We introduced IMTT to capture the informal sector. And progressively, the argument has been to say, but it's a blunt instrument, right? You are actually charging the informal sector, and the established corporates will then pay you the taxes. Make it tax deductible, which we have done. And we actually thought that the minister will actually get some applause for taking that action. It's a progressive action. So we will continue to work on it. But again, let's argue again, colleagues here. IMTT is now structural. That's the honest truth. It's now very much enshrined into the economy of Zimbabwe. Most of the associations here already provide for it in their costing structure. Go to the fuel industry, they've got a finance cost line. Go to the bread making industry, like Grain Millers Association. Yeah, I saw Tafaz earlier on. He shares with me his cost structure. It's already inbuilt. So I'm not even too sure that after making it tax deductible, Tafaz, visa line rakanzi financing cost, papa charge ye flour, ye chingwa, re ufu, because it's already provided for that. So we are watching very closely to see whether that line will be removed and for prices to come down, because that's what the tax deductibility should allow us to achieve. On the new digital services tax, there was already VAT, which was difficult to collect. We've just looked for a better methodology to collect. We have not introduced a new tax. We have just looked at it and say, what is the most efficient way of making sure that we can collect the tax? Lastly, so that I don't take much of my minister's time, I just want to correct one position here on the treasury bills, to say that there are outstanding treasury bills in the market. As of the 25th of September, all market-related, and that's why Dr. Moyo was trying to say, the market-related issuances were all fully settled. Government did not owe. We were owing on the so-called legacy debt to treasury bills. Those three long bonds. So Dr. Moyo is very right to say, can you differentiate these two different instruments, these long-term bonds and the market ones? Because from an accounting perspective, when it comes to marking to market, the accountants might not differentiate it. But we are looking at a completely different solution for the legacy debt bonds, because those were earmarked to be settled by certain cash flows which did not arise this year. And we expect that they will arise probably in the second to third quarter of 2026. So we are just looking and saying, how do we treat those maturities? But the pure, for both ZiG and US dollar, as of the 25th of September, government had settled all its obligations with the banks. I thank you.
Thank you. Thank you, Piers Gomatanga. I really wanted him to clarify those issues, and they've been clarified, indeed, with a lot of detail. Colleagues, first of all, let me really thank CZI and all the partners involved, PAZ and others, for organizing this session once again. In fact, with the comments I made earlier was, I want to see you more in my office during the year, visiting us, collaborating with Treasury as we build up to the midterm review of the budget and also beyond the midterm into the November budget. Let that be a new modality. Next year, I want to see more of you. I'm also inviting you, I've already invited CZI already and others, that let's do some joint research together between Treasury and BAZ. Why not? Treasury, CZI, Treasury, ZNCC, Treasury, Isaac Kwesu Mining. Let's do joint knowledge work together. That way, we can really enrich a policy going forward. So I look forward to that. And even signing MOUs, we can formalize and sign MOUs. Why not? That's how policies ought to be developed. So I look forward to that collaboration. Let me perhaps start with the theme of the budget itself. The theme of the budget refers to deepening economic growth and structural transformation towards achieving Vision 2030. You know, the basis for these drivers of growth is NDS2. So the new NDS2, and I'm going to send CZI, I'm going to send you a PDF version of NDS2 today, so that you can circulate it to anybody and everybody in this room. Then you will see why this is the basis for oh, actually there's some slides as well there. They'll be running as I speak. What you'll find in that NDS2 document is 10 pillars. These 10 pillars are the drivers of economic growth and transformation. So you've got, is there a summary of the pillars somewhere? I'm sure there is. Let's get to the pillars. So macroeconomic stability, colleagues have referred to that. Inclusive growth, infrastructure, housing, food security, agriculture, and the climate and environment, those kind of things. The digital economy and human capital development, creating jobs, making growth more inclusive, devolution, making sure that those in the provinces can contribute to choosing the projects that will change their lives, social development, gender issues, building the image of the country. What media is doing now is part of that a growth story which is driving the pillar of image building and communication, and then governance, peace and security. I always say that if you think peace is expensive and you don't want to finance security forces, try war. It's more expensive. So the minister gave them too much budget. No. You did it for peace. So these are the drivers of growth that we've identified through NDS2, and the budget is trying hard to finance these drivers of growth, for which then ministries are then mapped onto each of these pillars. And also the incentives that were put in place, the various taxes and so forth, also can be mapped to these pillars very, very easily. So I really wanted to start there and make that very, very clear. My second point really is on the slides. Please, all those slides that you present, I want all the slides. Nice. All of them. Beautiful slides, a very good detail. I really love your slides, all of them, without exception. I want those slides today. Let me start with the presentation. Was it Mukoko? Mukoko, did I get it right? Tinash, on whether are we growing or not. And his analysis shows that we are growing. It's very clear. So I don't understand why anyone would even doubt that we are growing. We are growing. You know, but there's someone out there is doubting that. You see, a little bit of economics, macroeconomics 101. There are 3 ways to compute GDP and its growth, right? There's what you call an incomes approach, then an expenditure approach, then a value-added approach. Those 3 should largely align. So by choosing delta as an example to show that's 0.82% correlation between delta sales growth and GDP, that really speaks to the big consumer goods, right? The consumption approach to GDP. So he's correct. Yeah. So consumption approach shows that the GDP is nothing other than a private consumption plus investment plus government expenditure minus taxes plus X minus M, which is exports minus imports. Remember it from first year economics, anybody? Y is equal to CIG minus T plus X minus M. Remember it? That's expenditure approach. Because we are basically changes Siegu incomes approach. Incomes approach recognizes 4 factors of production. Profits from capital, wages from labor, we have rent from property, and then we have interest from financial capital. And then again, you have to add the difference between taxes and subsidies. That's an incomes approach. So again, if you look at that delta analysis, the fact that the internationals pick the obviously sales, that speaks to the profits element of that. You could have done wages, could have done. Yeah. And then there's, I won't go into the VAT approach. That's too much of a lecture now. So that analysis is correct. In fact, when he comes to my office, I'll teach him a few more tricks. So colleagues, as I stand here, I personally have no doubt that Zimbabwe's GNI or GDP per capita will be 4,500 by year 2030. I have no doubt about the upper middle income status. Surely this economy can sustain growth rates of about 5% for the next 5 years. We achieved 5.6% average growth rate in the last 5 years with a lot of pressure, a lot of volatility and so forth. We still achieved it. Surely we can grow at 5.5% easily up to year 20. So I have no doubt that will be upper middle income. I also hear the comment about, is this growth shared? Well, it is government's job to make sure that growth is shared. Of course, one organic way to share growth is by growing jobs. We have been growing jobs. We have been growing jobs. You know Zimworks. I'll just use Zimworks as an example. You know Zimworks? Yes. They run the facility in the CBD. They're employing 1,500 people out of nowhere in the middle of Harare, right? You look at what other companies have done. They are employing Zimbabweans. The mining sector. Look, we like to create more and more jobs, of course, but jobs are being created. The construction industry, you still need bricklayers. That's manual labor in terms of the construction sector. So jobs are being created, but I think that jobs are being under-measured. We're not measuring the jobs created correctly, especially in the construction sector. But also government does a lot of the GDP sharing through the budget process. Easily 50% of the budget covers the social sector, health, education, Fumvudza, Intwasa, and the agricultural sector, social protection programs. That is a way to share the growth in the economy to those who are less fortunate, or to impact on the social sectors. And that 5% by the way, that half of the revenue is about 5% of GDP. So 5% of GDP is being earmarked for redistribution by government. So we're working hard to redistribute this growth, take from those who are making money, tax them a little bit more, including IMTT, and then we then support those who are in need. I think on the issue of IMTT, the Permanent Secretary has already dealt with this issue. Again, this issue of IMTT being tax deductible came from the private sector. They've been asking for it from the last 2 years. We at Treasury, because we're going through a tough time in terms of revenue collection, have been hesitant, but finally we have done it. Maoko. So we feel we are trying. We've even reduced by 0.5% the ZIG, IMTT, and so forth. So look, going forward, we'll look into it further and see if we need to do more. I can assure you, I can promise you, we'll continue to improve on that. There are certain things that I want to focus on from the various presentations. I think that James, again, very, very beautiful slides which I liked. But you seem to be concerned that while our revenues have grown from 2.7 billion in 2018 to 8 billion now, expenditure has also grown. Of course, once you raise the money, you must spend it. So it's okay. And it's good that we can afford it. The issue is the gap, which is a budget deficit. We've done very well. Our budget deficit has never gone above 2% of GDP, and we'll maintain it at that level. So let that expenditure go up, but it must be done properly, accommodate capital expenditure, accommodate all the social sectors that need to be supported. That is not a problem at all. You mentioned the issue of wage containment. That is correct. Our wage to revenue ratio right now, expenditure ratio, is of the order of 52, 53%. Our cutoff is 50%. So we're really trying hard to keep it within 50%. It's never easy, but we are very much conscious of this. I think the issue of the T-bills, P.S. Gumatanga has already clarified that the issue really was the legacy issues, which are being, there's a different treatment for those compared to the ones issued for the under normal market conditions. You raise an interesting point, James, regarding the level of monetization of the economy, looking at the M3 to GDP ratio. That ours is low, order of 10% compared to others maybe at 55%. And the same picture emerges when you look at the private credit extension to GDP ratio. We're on the low side. But that is a function of our history, our monetary history. We're still going through a transition. Those are the facts. It's a function of monetary history where we have a multi-currency regime now. When you try to look for some of the money, you won't find it. It's under pillows. Some of it is actually in the banks, in vaults, but it's not even being recorded. So if you were to add the money under the pillows, the money in the vaults, you may find that our M3 and other measures are actually higher than what is being recorded. But also, even if you wanted to a higher monetary aggregate GDP ratio, you cannot achieve that overnight. A precondition has to be the achievement of single-digit inflation in the first place. That should be embedded. Then you can think of trying to grow money supplies at levels that will accommodate the demand for credit in the economy. If you do it too quickly just to catch up with others, then your inflation won't come down. You won't achieve that single-digit inflation in domestic currency. So there are preconditions towards achievement of these higher monetary aggregates to GDP ratio. Also, you mentioned that our deposits are also on the low side, given the size of the economy. Again, it's a function of this multi-currency regime. People are keeping their US dollars in their safe deposit boxes and so forth. So you won't find them in the banking sector. But if you add all, you will find a different picture altogether. The issue about cash withdrawals, I think P.S. Komataga has dealt with that issue, that really we feel that the source of all this cash is the formal sector in the first place, is the banking sector. So, and what we're taxing is money that is exiting, is going one way. So really we feel that this is indeed justified. At $500, I don't expect civil servants to spend a lot of time withdrawing their cash. They should keep their money in there. They're within that $500 limit. Corporates, I'm thinking of corporates walking around with $10,000 cash. What are they doing with it? So, you can see how we're thinking about this, and that we feel that the way it's structured, it's okay, it's consistent with normal transaction behavior. Now, on the issue of VAT, I've heard the cry that, VAT will increase costs and so forth, inflation. Really? You mean that a 0.5% increase in VAT is a big deal in terms of costs? Really? Really? But I tell you where it is a big deal. It's on the revenue side. We'll raise from that 0.5%, who raise, let me tell them, I won't tell them the amount, but I know the figure. He almost said it, let's be quiet. Who raise something that will go a long way in supporting our vulnerable, the social sector, and so forth. So it's a big deal on the revenue side, but surely for payers, it's not a big deal, colleagues. Let's be honest. Let's be honest. On the issue of reserves, again, James, you did mention that we're making steady progress. Thanks for that. We are. But let me say something to challenge you. We are showing a 1.2 months import cover. Even that is an underestimate. Because if you have US dollars and you want to import, you just proceed. You don't come to the banks to look for US dollars. So in other words, we've got import cover covered by US dollars outside the banking system. Then import cover covered by US dollars in the system. So the overall import cover is sum of the two. So you will find, therefore, import cover is much higher. I've got a figure, but if I say it with the media recording, they will say, Minister, those figures. But I've got the figures. My import cover is way, way above. Because how many of you go to the bank to import? I don't see a hand up. So, but we import cover already. We private. I did it. So towards with the bank one, you find you have a different figure. Yeah. But anyway, that's for another day. So James, come, let's to the office, let's have a conversation. Then the comments from Mucha Mkanganwi, thank you for going back again to really emphasize the need for us to reduce the cost of doing business. As government, we take this very, very seriously. The last sector we looked at was the energy sector. The next sector is crops, a subset of agriculture, crops, and then horticulture. And then we look into the manufacturing sector. When it comes to the financial services sector, I propose that BAZ and the rest of the financial services on the security side and so forth, let's sit down. Let's sit down. You yourselves, the Treasury, also President Cabinet, let's have a thorough discussion on the areas that we want to impact in order to reduce the cost of doing business. It's very important. I've directed that the Financial Governance Forum, that they lead basically the development of a financial sector development strategy for the next 5 years. I've just received a draft 2 days ago. I would like that draft to be shared by all the key players in the financial services sector, so that we come up with a strategy that speaks to an upper middle income economy by 2030. The question is, what type of financial sector do we need to speak to an upper middle income economy? Surely we can't be a frontier market on the stock market. We need to be an emerging market. What does it take to move from a frontier market to an emerging market? We need to see more investment banking products within the banking sector, beyond what our colleagues are doing in banking. They're making good money, by the way, they're doing very well, but the investment banking product, we need more of those, because that's what drives innovation, new projects, and so forth. What do we need to do? So that strategy, plus this cost of doing business exercise, are critical things that we need to look at. I envisage that we could sit down, let's say about mid-January next year, targeting beginning of February, to present to Cabinet proposals on the cost of doing business. We then also look into, by the way, the mining sector. So as a question, your sector is never easy. So with mining, we always try to balance fairness, depletability of the resource, versus lowering the cost of doing business. It's always a fine balance. So I think that's the last sector we'll consider, mining. It needs time. We'll engage. Then on the issue, which I mentioned on de-dollarization, thank you for acknowledging the clarity in the document. Colleagues, I urge you to really read this document, the thick document of the budget statement. It's a well-written document, not because we wrote it. at least you will see exactly how we are thinking, and I think that we've been logical. We really tried hard to be logical. So what's important with de-dollarization is the conditions precedent, which is we need single-digit inflation. We need import cover to be above the 6 months, 3 to 6 months zone. We also need to grandfather all the US dollar contracts that banks have contracted out there and everybody else. Those are conditions precedent. Actually, we don't need a date. We don't need a date of December 31, 20. Let's